The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Good morning, this is Brian Akers from Akers Financial Group, and we welcome you to Winning in Retirement. I'm a certified financial planner practitioner, and I have with me today a certified financial planner practitioner and advisor here at Akers Financial Group, Alex Monk. Good morning, Alex.
Ryan, it's good to be with you.
It's good to have you around. It's good to have you here for our show today. Alex and I have been talking about this show and thinking about what to say. There's a lot going on right now, and we want this show to be one that'll basically try to help you where things are at the moment. When we were designing this show, we wanted to make sure that those that are retiring into this, people that are already retired, or even if retirement's far in the future, it's always a good time to hear and think about things and to actually get a second opinion of what's going on. Expectations are that life and investments and expenses are all going to be very volatile here in the near term. We need to put a plan together to survive and thrive. And that brings us to our show today, Retiring in a Recession. Alex, are you really ready for a show like this?
Oh, man. I mean, we've been talking about this all week, and it's the right topic to have right now, Brian, because there's a lot going on. I know you've been getting some phone calls. I've been getting some phone calls, some emails.
Well, honestly, is this a surprise to us at Akers Financial Group?
No, it's not.
And it's not, absolutely not. And if you've listened to the show for a long time, you've realized we've given a lot of advice on how to handle your retirement years. As you get closer and closer to retirement, there's certain things you need to do so that you're prepared for this moment, this exact moment.
You know, it's not a surprise either, Brian. I mean, you look back at the charts, you look at history, That's our best gauge of the market, right? And let's say you're going to be retired for 30 years. Statistically, there's going to be two bad times.
There's going to be business cycles that come through.
Right.
And then we did not have a normal business cycle here. We had a pandemic, and then we had government, a lot of extra money given out from the government, which increased a lot of things. And then there's just the overall supply problems. There's a lot going on. And then we have this thing called gas prices, which cost 2 arms, 3 legs now.
Yep. Also a firstborn. It just depends on what kind of car you drive.
Yeah, definitely.
And if it's a diesel, I'm so sorry.
Yeah,
it's terrible. It's like $6 a gallon or something. That's crazy.
Right. So we're talking about here is those that are actually trying to retire right now. And I had one of our listeners, longtime listeners, him and his wife came in to talk about retiring right now. And so what I want to do here in the first quarter is just bring up a little bit about that conversation. But the thoughts for the show today about retiring in a recession, we're effectively not in a recession yet. Is that what they're telling us?
I think you put it best, right before we were getting prepared. A recession is one of those things that you look in your rear view and you see and you're like, oh,
yeah,
that's what just happened.
Yeah, last quarter was negative. That's a recession.
Right.
I'm like, okay, thanks.
Appreciate it. But, and like you said earlier, we're going through some weird stuff because you got prices that are inflated and some of that supply chain, some of that supply and demand. But inflation's here, all right? And we got to deal with it.
Absolutely. Now, the recession, a lot of times when you look at the definition, an economic recession is a loss of business and consumer confidence. That's what it starts with. And the confidence recedes, and so does demand. A recession is a tipping point in a business cycle when ongoing economic growth peaks, reverses, and becomes ongoing economic contraction where things slow down. Now, when they raise interest rates like they've been doing, that's to slow it down, like putting water on a fire, trying to slow it down. The idea is we're coming out of a pandemic time where there is a fast speed, where people want to get going. People want to spend some money they've saved for a couple of years. There is this demand that's out there. Is it truly going to slow demand the way they think? Will it actually slow it to where there is no growth? These are all like teasers to some type of movie, but
or watching the news, right? I mean, if you watch CNBC, you have 6 different people on there, all experts in their said field, and none of them have the answer.
Right, because we have not had this exact scenario in a tremendously long time when it comes to all these pieces are pressuring the economic environment we're in. It's not as simple as, raise interest rates and things will slow down right away. It's not, because there's pent-up demand. Absolutely. Some people have not traveled in a couple years. They're ready to travel, no matter what price tag they put on it.
Well, or they may have already paid for it. I mean, they could have paid for it 3 years.
In 2019, they paid for it. And let's get going.
Right. So, and people that are retired, they want to do these things. They want to see their families. Mm-hmm. So that money's it has to go somewhere. But then you have other consumers that might have been taking too much risk coming into this.
Absolutely.
Feeling real rich with the market up. And then, some of those names are down 60, 80%.
There's this concept that we talk about in our investment committee, and Bernie from our investment committee brought this up, and he said that inflation seems to be on everything we need right now, and deflation is on everything we have. Now, to me, that means a lot. Inflation is where we pay more and more and more for everything we need. Deflation means on our investments, like if you look at cryptocurrencies, you look at the beginning of real estate pulling back down, but stock market deflation, we're losing our value of the assets we had based on the peaks of 2021.
And those peaks were just, for most people, unless you sold that day, they're just numbers, right?
But it's the number everybody remembers. They walk in their office first time meeting, they'll say, hey, on November or whatever that date was, that was my peak. Or if they're high tech, it was about a year, 14 months ago when they hit their peak on their tech, off 100% tech portfolios before it got hit 50, 80%.
Well, and if you look at the charts, right, tech will come back. There will be more tech in the future, but it's going to go through a rotation. I mean, markets have to do these things.
Rotation. That means not all tech's coming back. I don't know if some of those COVID stocks, the ones that were hot during that lockdown time, are going to come back the way they were. They went a little crazy, high. Probably not coming all the way back, so don't try to hold on for that.
Yeah, I mean, you got to have the right names in the right environment, and you have to, that's why we meet with our clients every 6 months, because markets change.
Absolutely. So if you listen to Winning in Retirement, we've talked about take the least amount of risk to reach your goals. Don't take the most amount of risk. Some people over the last few years have taken the most amount of risk with their money, and now they've seen a 50% decline on their assets, and they're like, what do I do now? Now, if this is your retirement year and you're in that kind of situation, you need to take a conservative, fundamental approach to your financial planning and then figure out what is your at-risk money and what money could you truly risk like this, and make sure you're properly balanced.
Yeah, and that's a big conversation I've been having with people, Brian, is that at-risk money and that not at-risk money. And there's a difference, because your bonds are at risk.
Oh, bonds are at risk. We got the stocks that have been at risk. Not all stocks, but a lot of the ones that have been high growth the last couple of years have been pulling back very quickly.
And I read a report yesterday. Like the big push about a year or so ago was ESG, or social investing.
Sure.
And guess what's been the number one stock category?
Well, it's been energy stocks, but some of the energy stocks are starting to look at ESG. Some of their board has changed to where the ESG becomes a priority there. So they're going to try to look at it and try to have some balance with the environment, which I think is a good thing.
I think it's a good thing too, but it's like, do you just exclude a whole section of a market that could be like the buoy? I mean, it's such a tough thing. It's like, do you know where your money is? Is that money agreeing with what you're trying to do?
Yeah. So, all right. So we have clients walking in the door, and like the one that's a long-time listener, they say, well, we're thinking about retiring in this next year. We're not sure if we can. And so we had a talk, just like we do with anybody who wants to sit down with one of our team of advisors. We have a talk about where they are now. We call that a financial fingerprint. We're not going to fingerprint you. We just talk about you with you there, though.
I did have someone ask if they needed to bring their fingerprints yesterday.
Oh, yeah, I know. I heard that phone call came in, and I'm like, oh, our marketing's good, but maybe not good enough. Then I was thinking about, okay, so the client, the longtime listener, brought everything. It was wonderful. It had lots of information, and trying to get a second opinion. I'm like, well, second opinions are hard to do all in one meeting, but I'll do the best I can to give them some ideas, some things they need to think about. Because in an inflationary time, in a recession possibly coming, what can we do that's maybe a little different than we've been doing? And so throughout this show today, we're going to bring up ideas that you need to think about, things that you need to put in place to make your money last a lifetime, no matter what is coming our way. No matter.
Yeah, and the peace of mind that you get knowing that you're, and I always set my plans up. I want to be fine in the worst case scenario.
Yep.
And then I'm okay. Like, it doesn't matter.
Absolutely. One of Jim Cramer's first books, in the first chapter, he says, I'll have lots of investment ideas, a lot of information in here, but you need to build your nest egg and have that invested conservatively and set that apart. And then the rest of this book is about what you do with the other money, the money that you can afford to lose. We're talking about financial planning and retirement planning. For most Americans, there's not a portion you can afford to lose. It's about making this money basically be there to replace your job that you used to have. It's there to provide you the income you need today and 30 years from now.
Yeah, and these markets recently have unfortunately taught a lot of people lessons, and that's what we're here for, is let me give you that second opinion.
What if I've already learned my lessons? I had I began in like the 87 crash, so I got that Monday, 27% in one day.
Was that your first day?
No, it was my, I started in August, October. But I went away to college, came back for the fall break. And
Whack.
Yeah, that was lovely. And then I worked at Christmas after that. But so 87 was a doozy. 98, that was a tough little short span. 2002, 2001, 2008, 9. There's been these events, major events in life, or in the markets and financials, that have really, truly sort of molded me to make sure that my retirees are ready for the worst, because things will not always keep going up.
No.
And we got to make sure money lasts as long as we do.
Yeah, and we want those people to have a peace of mind, Brian. I mean, you don't want to worry about this stuff every single day while you're retired. It sounds terrible.
It does. It'd be nice to give it to an advisor that can handle it for you. And then we have good talks with our clients each year where we talk about their situation and what they should be doing. We have a different approach to what's going on. We have a different approach to how we implement the plan. We do. And that's because, I have to say it, you're different, Alex. Have anyone ever told you that?
I have. I've heard that before.
And the reason that we're different is that when our clients are 70, 80, 90 years old, they have the money they need. The things are set the way they need to go. And then when their kids come in later in life and say, well, you did a great job with our kids, that's the compliment we're looking for, is when things are done throughout your entire life. You look at the job that we did for our clients is a job well done. That's very important to me. This idea at Akers Financial Group is where we are independent. We're local. We don't report to a big company on Wall Street. We report to you. We report to you and your family. It might be now or even in the future, like I was just saying. We do have offices in Lutherville and Forest Hill. We do meet with clients all around the country and some around the world. We would love to meet with you to have a free consultation with one of our team of advisors. All you got to do is give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or visit or call us at 833-946-7384 to start planning for your retirement now. Can your income increase guaranteed during your retirement years? We'll talk about that in 2 minutes in the second quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Hello, it's Brian Akers from Akers Financial Group, certified financial planner practitioners, myself, and the other person with me today is Alex Monk. Ready to go here in the second quarter, Alex?
Oh, I'm ready to do some certified financial planning and practicing.
And practicing with general advice at this moment. But Winning in Retirement is a show that we put together each week for our clients, for our listeners, for people to get educated and understand what's so important about what they need to do now. No matter what your age is, it's important to take advantage of this information to make your plan be there for you throughout the years. The show today is called Retiring in a Recession. Not to depress you today, not going to do that. We want to be that lighthouse in the storm. We want to be that bright blinking light. Yes, you're going to make it. Put your head up, look, turn some things off, stop listening to the noise. Understand your long-term plan and how to make it work during times like this.
Yeah, and I really enjoy being able to take the emotion out of it for people. Because it can be emotional. Money's involved. There's a recession. There's a depression. There's all these weird things.
Oh, they always can calculate from the very peak of the market to where they are now if they lost money, and they know exactly how much they lost when they come in to visit, and they say, well, I lost this dollar amount. And then the concept is, well, how does that work within your plan? Now, generally, what we try to do is avoid large losses. We try to make sure money's going to be there, especially when we need the money for income. So this second quarter, we're dedicating to this question. Can your income increase? And then I'm going to bring out this word, guaranteed, during your retirement years.
Well, if you're on Social Security, Brian, It'll increase.
It will,
Allegedly.
but not guaranteed.
Not guaranteed.
So income during retirement, there's lots of sources. They have Social Security, we have pensions, and then we have our investments where we can live off of them. Now, the idea is this. There are investment vehicles out there that can provide guarantees. Typically, they're through insurance companies.
Yep. Typically, anything that's in the stock market is not going to have that word associated with it.
Yeah, and it won't have guaranteed. It won't have guaranteed on the income. The dividends are not guaranteed. They can stop. They can lower them. Even interest on your CD if you want to live off interest. No one's been able to do that for a decade. But if you want to live off of interest, that used to be a thing, it hasn't been recently.
And you'd have to have a lot of cash.
Yeah. Yeah, and you have to basically eat cash if you're living off interest off your bank account.
Yeah. So we're talking about stuff that's issued by an insurance company, right? So those are the companies that give us those guarantees. It's the same companies that may insure your house or your car, or your boat, or whatever.
Yeah, and I think about annuities over time, and we think about listeners when they come in and they talk about old annuities that that were sold to people where they talked about 7 and 8% guaranteed. Do you remember those topics from years ago?
Oh, that sounds like a good old roll-up play there, Brian.
Yeah, the roll-up play was the fact that there was no guarantee of 7 or 8% on annuity policies like that. But some clients that come in to see us have old policies, ones that have been around, and we try to help them know how they work.
Yeah, so that roll-up that these things were sold underneath is different than the cash value. It's an income base.
Right.
So it's two different numbers completely.
But if you have one, if you don't take the income base, you'll never see the roll-up rider or the fee that you're paying to have your income portion roll up and get larger over the years.
Yeah, and we're not a scorched earth place at all. I love some of these old policies because you can't go out and get them again. And a lot of times it's the client's best interest to use the roll-up. I mean, you've been paying the fee for 20 years in some cases. Let's use it. Right.
So if you have something you don't understand, you have a fixed index annuity that has an income rider, or you have this roll up where you thought you're making 6, 7, 8% a year, but then you're not really making that on your cash value. But there are other ways to use these policies. Now, you're not going to see us to be someone's going to get rid of those because that income rider and knowing how to use it is extremely important.
Yeah, I mean, a lot of times the income account value can be double the cash value. So, I mean, where are you going to go to double your money? You just can't do it. So you need to use those guaranteed payments as part of your income flow and use what you've been paying for. Now, a lot of times they're not the best policies, but they're policies you may not be able to get anymore. So you got to use whatever's available.
Right. And the word use is this, that you turn on the payment. It can be a monthly payment or an annual payment, and that'll be coming into you. You do that instead of just doing a withdrawal. There are tricks to these kind of things. Now, the idea of having income that can increase guaranteed during your retirement years is extremely hard to get. There are some annuities out there which are provided, the protections provided by the assets of the insurance company, not FDIC. Some of them will have a guarantee where it will increase so much a year, sort of like an automatic cost of living, and others have a cost of living based on how the contract performs. So that's not a guarantee rate. The fact that it could go up based on how the market does inside the policy.
But that is a way that you can get increasing income without stock market risk per se, kind of.
Absolutely.
Right? I mean, you're not taking any market risk.
Yeah, not market risk. You risk your interest is about the only thing on a fixed index annuity. That's a whole radio show by itself to explain that in greater detail. We can explain that if you just give us a call, of course. You can go to akersfinancialgroup.com, check us out there if you have questions about that.
Yeah, and if you haven't talked to the guy that sold you the policy, that's an issue.
Yeah.
You need to talk to somebody. Because, I mean, I've done so many home improvement projects, and the ones that I start without calling somebody that's done it before usually end up horribly.
I don't know where you're going with that topic, but I think it's going to be a long show if we start hitting up on certain projects.
No, but I'm just saying, it's like, why
Any
would
good
you
examples?
Not? Oh,
no,
I don't want to bring that up.
That's okay. But imagine we have a financial planning improvement project. We're going to work on how to improve your finances. That's what I see when a new client comes in is, how can we make them better off? Right. And I'll start writing in my notes. All right, add 1, 2, 3. And I start, the other day when I met with a long-time listener, I wrote down like 9 things I was thinking about stuff they could do to make it even better.
Yeah, and it's fun for me because it's like a puzzle. It's like, okay, well, let's see what you got. What do you have available? Because there's some things that are available to people they don't even know about. And then it's like, okay, well, what are we missing?
Yeah, absolutely.
And then where are our fundamental flaws? Let's make sure worst case scenarios are covered. And then let's figure out what makes you tick, because it's really about you and your retirement. The money's a byproduct.
Yeah, but some people don't want to hear what they need to hear, and that is things such as get your budget in line, pay off your debts so that there's no bills in retirement. We've always talked on Winning in Retirement about having the lower amount of bills. No debt means you can actually afford retirement a lot easier. Getting rid of debt might mean you have to work a few more months longer. You might need to stop saving in your 401k and pay off your debt. You might need to do something extraordinary like that.
And sometimes if it's like such a budgeting issue, I tell people then, look, you're going to have to keep working. I mean, there's no way around it. But do some of those vacations while you're working and while you're healthy, if that's the only way that you can afford it. Because there's no miracle bullet out there, no magic pill or whatever. You got to put the work in.
Yeah, I do a thing where I say, well, there's plus, that's income coming in, and negative, money going out. We can't have more money going out than what's coming in, and that's it. We can't change that math. We got to see, well, what's coming in and what's going out. And we need to know where money's going to and make sure we can balance it out. Very, very important.
Yeah, and I mean, this is what we do. I mean, don't get all worried about it. We're here to help you. I mean, I'll show you how to do your budget. We can walk through it. You can usually tell me just how you live your lifestyle, and I can mathematically do your budget in my brain while you're telling me, oh, you have this car. Oh, you have that house.
But you're not judging.
I'm not judging. I'm just adding. I mean, I've seen all kinds of weird stuff. Trust me. You're not going to bring something that's going to wow me, and I know you're not going to wow Brian.
Hey, I enjoy my clients. There's some wow factor there.
Well, I mean, there's nothing that you're like, wow, I've never seen that before.
I had a new client who was a top 10 song in Japan. Was a singer on a group. Thought that was pretty interesting.
Well, that's a new one.
That wowed me.
That would wow me too. Did you listen to it?
I actually did. It was pretty good. All right, I'm sorry. Totally off subject. Now, I know you like onions and you want to talk about onions?
Yeah, so think about your retirement income kind of like an onion, right? So you got your core, and then there's layers on top of it.
You're making me cry already.
Oh, I'm so sorry. So in your core, you got maybe Social Security, maybe a pension.
Okay.
And so let's just assume that they're going to be flat, right? So the
Sure. Flat meaning no raises.
No raises.
No automatic raises.
And by that, I mean, let's just assume that Medicare is going to take all your raises.
Yeah,
or your
Social
health
Security.
care costs.
Oh, yeah.
So that's a push there. And that's that inside of your onion, the part you usually throw out. It's real flat, skinny. But then you want to add stuff around the outside. And that would be other guaranteed income sources. But you want to build that core first so that you can take this, risk with other parts of your money. So by having different types of policies, typically insurance-based stuff, that's going to guarantee you payments. If you can build that core out to meet what you need, and then you can throw in another layer, maybe dividends, maybe real estate income,
Right.
Interest if that ever comes back. I hope it's not on a bond fund, but we'll get into that later. And then the last part would be stock market growth, because you can't count on that. You just can't.
Well, you can't count on it for income. We're going to count on it as a long-term how to defeat inflation.
Right.
So your onion has a core.
Yep.
And the core was what again?
Social Security, pension.
Okay. And then each layer is investing?
Well, each layer is different types of investing.
Okay.
So the second layer, you're going to use insurance-based stuff.
Sure.
Guarantees, right? You're not going to make a ton of money.
Right.
It's just not there. But you're not going to lose.
It's that protection we all need that we don't always get with what we invest in.
Correct. And that's such a big deal, because if that core can meet your needs, you don't have to worry about the noise in the market. And then we can actually be long-term investors,
Right.
which the stock market requires. And this is an event that flushes out that short-term money, or people that, take a little bit too much risk, get a little bit greedy. Not to say that I want to see people lose money, but it happens.
Absolutely. The risk level can get really high and get real carried away with success. Fear, hope, and greed. What happens is things go up. You're very hopeful, keeps going up. When it starts rising and rising, you get a little greedy, assuming it's going to go forever. And markets do not go up forever. The other advice we'd like to give is that things don't go down forever. When things are down, when we sit down and talk with people right now, we're not talking about that history of where money's been up and down. We're talking about the now. and what to do right now to make your situation even better for your future. Because in retirement, your biggest worry needs to be where you're going to drink your morning cup of coffee. It doesn't need to be where your statements are or how you're doing or what stock's up today or watching everything on your values constantly. What you need is to have every day seem like a Saturday, free of stress, where your retirement income and investments are all taken care of by a team of advisors at Akers Financial Group. If this is the future you want, it's not too late. It's so easy to begin winning in retirement. Just go ahead and meet with one of our team of advisors, a free meeting with you and talk about your retirement. You can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule a free in-person or Zoom meeting. Go ahead to AkersFinancialGroup.com or give us a call at 833-946-7384 to start planning for your retirement now. Target date funds may not hit the target you desire. You need to know the truth about this, and we'll talk about it in the third quarter coming up in 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers. Thank you, announcer, for welcoming us back, and we welcome you to our show. I am Brian Akers, and here with me today is Alex Monk, a financial advisor, certified financial planner practitioner from Akers Financial Group. Are you ready to go here in the second half, Alex?
Let's do this, Brian.
Second half is a big time in the game. Are you more of a second half player or a first half player?
Well, I think you know the answer to that. I'm a second half guy.
Would that be back nine guy? Or golf's more your sport nowadays, right?
Yeah. And I don't walk the course either, so it doesn't matter. I'll play all 18.
Oh, man, I usually give up by 14. I'm usually so worn out trying to find my ball. Yes, golf is a hide-and-go-seek game for me. All right, our show, Winning in Retirement, today is called, we are basically working on retiring in a recession as our general topic of volatility and all that's going on and how it's affecting us and how we need to think through it and understand that we have to have a good plan to be able to handle everything that's going to be thrown at us this year and the next few years to come.
Yeah, it's not over yet, Brian. There's still a lot of lingering issues out there, some COVID-related stuff. There's all kinds of stuff. It's all brand new, too.
Absolutely, and that is all part of a financial plan that's built for you, built for your best interest, built for your situation where you are now. We just happen to call that your unique financial fingerprint. Understanding where you are now so you can build a plan to make sure you reach each and every goal that you have. All right, this third quarter, the topic is target date funds may not hit the target you desire. You need to know the truth about this. Now, people who have listened to the show before have heard our opinion, but Monk, can you reiterate our opinion of target date funds? And
I'd be glad to.
Okay.
So target date funds, does anyone know what's in their target date fund? I mean, I don't think many of them do.
Well, they know that's like a barometer. I can get riskier or lower risk. Some of my clients in near retirement have like a 2055, even though they're like 65 years old, because they want to be riskier. And then the opposite, someone take low risk, they'll be a 2020 plan.
So typically what they are is they're a collection of funds based on whoever is running that said target date fund.
Sure.
And they scale risk back over time or as you get closer to retirement by using things like bonds and cash.
Sure.
Typically 2 to 3% cash is the most I've seen inside of these things recently. Mm-hmm. So let me I'll hit you with this hypothetical here, Brian. Let me say that interest rates might be going up. Like that's a known fact, okay? And bonds, they act inversely to interest rates. So when interest rates go up, your bonds value, the value of your bonds is going to go down. So let's say that you're in a 2020 retirement income model and you have, I don't know, let's call it 50% bond funds in there. You've lost 11, 12% just on that portion, not to mention the other 50%, which is in the market and maybe down 20, 23 overall. So that sounds like a blended return of, minus 17 or something like that. That does not sound like a portfolio for retirement. That's a big negative.
Yeah, because of the risk, right?
Because of the risk level.
And the risk of losing your actual money.
Correct. So if you use something like a stable value fund or a fixed annuity, fixed index annuity, then your downside would be 0.
Right.
So then let's just say the other 50% of your money was down to 20 or 27, whatever I said. So then maybe you're down 10 overall. So that's half of the market. That's called beta. So
Okay.
you want to have a beta of about 0.3 to 0.5, I think, in retirement. Like you want to do a quarter, a third, maybe just half of what the market does on the downside.
Yeah. So target date, a lot of them are tied around something like a 60-40 mix as someone gets closer to retirement, with the 60% being in stocks.
Yep.
Then that 40% being in bond funds.
Correct.
If it's run by a family of funds, typically they only use the funds of that family to fill in every category that they want in their model. And many times in the target date funds, they'll use every fund in their family. And so they'll design sort of a two-tiered system. One is where they have the allocation model. Sometimes there's a fee for that. And then internally, you own a little bit of every fund, and there's fees inside for that. And so understanding the structure is very important of your target date fund, understanding what's going on. I understand the ease of it at work, at a 401k plan. So the employer no longer is saying, oh, invest in the company's stock anymore. They're saying, buy a diversified portfolio. And we have these models built already by the provider of the plan at that moment.
Right. They're plan fiduciary, if you will.
Yeah. To meet all the 404
Right.
rules.
So they have to follow the rules, and I get that. And, you know, it's good that they're pushing people towards investing, but we're saying, hey, people, you're investing your money. Look at it.
Mm-hmm. Yeah,
Let's take some time and look at it.
Look at it, know what the target date fund's actually buying. So like one example might be is you're getting close to retirement and you have, let's say you want to retire in 2025 and you buy the 2025 plan. And do you know what you actually own inside of there?
I would say most people have no clue. And I would bet most people would be shocked by how much international exposure they have right now.
Stocks and international bonds.
I know.
That means you're lending money into foreign countries. And do you know what countries it's in, where it's concentrated in? Did you pick it? We believe in having high quality investments at every level and knowing what you own. And that's how we build models here. It's how we actively manage money here, is we want to know what we own. It seems like a simple concept. With our clients that are actively working and saving and growing, we help them with the 401k choices. If the 401k has a lot of choices, we try to teach them what's available inside of there. TSP, 403B, TIA-CREF, we guide them through the choices that are available.
Yeah, and the nicest part about being, you know, a full-scale financial planner is I don't have to pick one risk level for every single account.
Right.
I can look at an account and say, all right, well, this is our options here. This is what we can get really, really good stuff to accomplish X, Y, and Z.
Right.
So that means I can take a look at the other part of the portfolio and I can adjust things that way and look from a top-down approach versus just saying, oh, this person's 52, moderate, done.
Right. Oh, yeah. And then you think about people that save at work might be their only way of saving when we first meet them. It's like, oh, I save at work and they have all their money there. It's all in this fund. And then we say, well, let's look at the allocation. And we say to them, oh, you're 37% U.S. stocks. You're, let's say 27% bonds and you have 20% foreign stocks. You're around 10, 11% foreign bonds. Where's the no risk side of your portfolio as you get close? Where's the zero risk? In your 401k, do we even offer a zero risk type account?
Well, and now interest rates are starting to pop up. So you might have a stable value account that's approaching 3% a year.
Oh, I haven't seen that.
I haven't seen it quite there yet.
I see 1.5, but
I saw 1.79 annualized.
Oh, nice.
So rates aren't quite getting there yet,
Yeah,
but they should.
I understand. So what's happening is this, is that when we're talking about target date funds, and that comes like when you basically go to work and you pick basically you check a box. They throw you in this plan. What we ask you to do if you become a client of ours is let's see your options. Let's see what's available at your work and take a look at that. And then also if someone's 59 and a half, they have other options. What's one of the great options at 59 and a half at a lot of companies?
That's a lovely in-service withdrawal.
In-service withdrawal means once you're 59 and a half, some companies allow to roll over some or a portion of your 401k, if it makes sense, to do something different.
Right.
A lot of times we're doing that to give it the opportunity to build the protected side, which is not available at the work options.
And then some of these plans, Brian, now are adding this protected side in there, but people don't realize it's a lifetime decision.
With what they're putting inside the 401k plans, it is.
Right.
Yeah.
And we would never, that just seems crazy to me, because let's just say you're panicking a little bit when things are going bad and you pick something that you don't really know what it is, and now you're stuck in it for life.
Yep.
That sounds terrible to me.
But that's what's happening with the new options that are giving with some of these redesigns of retirement plans.
I know.
And they're doing annuity options. Now, we use annuities as tools, but we do not want to make it a lifetime decision when it comes to picking an annuity. We want to pick the best rated annuity with the best interest for what we need to accomplish. It's the right tool for the right time.
And not all one. We got to spread it across time periods so that they come and they renew at different times, so that we're not locking in interest rates. And you never want to have all your money in any one thing.
And the reason we're talking about all of this is that retiring in a recession, the first thing you have is this belief that things are slowing down, that things are contracting, and that things are going to get worse. And so you want to hold money tighter. You want to be closer with your money. And you say, oh, I'm in a target date fund. It's taking less risk. And then you look at your return, like, oh my, I lost more than I thought, because the lower risk side was risky, just like the risky side. And that's the concept that we've always tried to talk about on the show, is this: make your protected protected. Why do we need to have risk with money that we would love to have it protected?
And it's no fault of people out there. That's what we do.
Yeah.
I mean, I'm more than happy to walk people through all their different options, ways to do it. But I look at it as, from a portfolio construction standpoint, I don't own bonds in our portfolios because we use fixed index annuities.
Right. The only time we're buying a bond right now is we're having clients on their own go to U.S. Treasury Direct and buy I-bonds. I-bonds have a 6-month interest rate above 9% right now.
Yeah.
And there's a limited amount of money people can put in, things like $10,000 total. So it's not like something you can move all your CD money to, but it's something worthwhile checking into for your more liquid money that's not in your retirement plans, something where you can have something earning a lot better rate than zero.
And I love using bond replacement as the way to construct a portfolio, because I know for a fact I have something that's not going to go down.
And so what happens is, when you build a portfolio where a portion has protected from downside, when you report your return in a down market, we say, oh, we're down 4, we're down 7, while the market's down 20. And they're like, how'd that happen? I said, well, our plan worked. And our plan worked because we took less risk from the beginning, and we don't want to lose your money, because big losses are hard to make up, especially in your retirement years.
Yep. If you're needing money, like if you need a paycheck from there and you have to sell when it's down, guess what?
It's not fun.
Nope.
What we like to do is be a year ahead on income if we can, because we got to make sure retirement is built for you, and all the variables that happen in retirement are built for your exact situation. Because we all know the best part of retirement is getting your retirement back. Your time back. You decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. You go to our website at akersfinancialgroup.com, scroll down to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com, or you can give us a call at 833-946-7384 to start planning for your retirement now. Now, Akers Financial Group, we're going to have our fourth quarter coming up here in a minute, and that topic is this: every economic cycle has its opportunities, including recessions. We will discuss these opportunities when we come back for the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
I'm Brian Akers, and here with me today is Alex Monk, both certified financial planner practitioners from Akers Financial Group right here in Maryland, but we work with clients all around the United States and a few around the world, actually. Alex has been with us for more than 10 years.
Yikes.
Are you doing okay? Surviving the 10 years?
I had hair when I started.
Yeah, I have photos of that. You're pretty young. Now you got a lot going on. It's pretty awesome to see what you've grown into. And what's awesome is that as one of the the chairman of our investment committee and as a certified financial planner. You bring a lot to the table for our clients, and I really appreciate that. This show today has been Retiring in a Recession, talking about what's going on and what we recommend people need to do to make sure their money lasts a lifetime. Understanding that planning is what you have to do to make sure you're okay. It gives you that ability to breathe and to understand things are okay. And then we can just really, truly build for the goals in the future that you have. The more conservative and fundamental your plan is, you're going to be okay through this. I think it's good to understand that you're going to be okay. And that's what this show's been all about. If you ever want to go back and hear it again, you go to our website at akersfinancialgroup.com, akersfinancialgroup.com. Up top there, you see radio tab. Under there is our last year's recordings. They're all there. You can hear it again and again and again.
Or, and go back and listen to what we talk about when the markets are high.
Oh, yeah. Go back multiple shows we've had in the last 6 months, trying to explain about the market's high. We need to balance things out, make sure you're doing the right thing for the future because things will come back down. We're not trying to prophesy a market return next week or anything like that. But the idea is we need to think about our future, your future, to make this money last, to make this money grow and become what you need it to do without taking too much risk.
And when a client calls me and they're just like, Alex, am I going to be okay to retire? I don't take that lightly.
Absolutely. You want to think about it, talk about the situation, what's going on. I started the show talking about one of our longtime listeners came in for a second opinion. It was awesome to see the people we actually talked to on Saturday mornings. It was great because they listen, they know what our thinking is. What's cool is they've done a tremendously good job of planning. But then when you start bringing it all together, doing the second opinion, it's like, well, these are some more ideas that would help that exact situation. And that's what we offer to anybody that listens to our show, is to give us a call at 833-WIN-RETIRE or go to our website, akersfinancialgroup.com, and get that second opinion about where you are now and what you need to do to make sure this money is successful and works for you through your retirement years. Now, this fourth quarter is about every economic cycle has its opportunities, including recessions. Officially, we're not sure if we're in a recession yet. I've always seen that we know we're in a recession about 2 months after it's over.
They sell a litmus test on Amazon if you put it in your water.
Oh, yeah?
No, that's not how it works at all.
Oh, no, so there's no recession
there's no recession
label.
Test.
I think that we've had a high growth rate on our economy, and I think that to assume that it's going to go all the way to negative in the short run is probably hard to believe that we'll drop all the way down there. I hope we doesn't drop that fast, that hard. That might be one definition of a true recession is the negative growth. Now, there will be negative quarters. A couple of them in a row is another way of calling a recession down.
Or contraction.
A contraction, but just the general definition that people are going to contract and basically be more conservative on their money. They're going to say, oh, that PE ratio is too high for a stock, which is happening now. Or that stock doesn't produce anything. It shouldn't be worth 100 times earnings. They don't even have earnings. It shouldn't be worth that high. Those are realistic, and in my opinion, are what you should evaluate every stock at every turn of the market.
Right. And if you've got your core built out, if you have, all your bases covered and you want to take some risk, go for it.
Absolutely.
That's what that's for. And you might hit 1 out of 5 out of the park, but 4 out of 5 you might miss.
Yeah, sounds like some people that play baseball. They strike out more than they hit, and then they get a good contract because they get the home run once in a while.
Yeah, I'm not going to talk about
baseball. Or him. Oh, no, we're not going to bring up anybody in the past history. We're talking about the future here. Now, economic cycles, that means there are growth times, and then there's the slowdown of business. And what happens in slowdowns? Things slow down. There will be things such as supply issues coming up. The supply issues are not going away quickly. They're going to take a couple years to get back to where we were in 2019 when it comes to the supply chain.
Just think about a Christmas tree. It takes 8 years to grow one. If you stop planting them for 2 years...
Yeah.
What are you going to do?
Have socks for a tree?
Have smaller trees.
Smaller trees, that's true. Now, my roommates in college, we had a little stick and we put some socks on it. That was our Christmas tree. Yeah, not too bad. I had a forest ranger as a college roommate and didn't want to hurt a tree, so it worked out. All right, I'm sorry. I jump out there.
But there's a lot of opportunities, right? That's what we want to talk about.
Yeah, we see opportunities in the market of dividend stocks that pay you to own them. We think that's an obvious piece to have in a portfolio for retirees.
Yeah, and actually they're not down on the year, which is crazy.
And the reason they're not down on the year is because there's a flight to quality in times like this. Where does the money go when it jumps out of high-risk stocks? It goes to quality stocks, stocks that pay their bills, that raise their dividend, take their money and buy back their stock. These are conservative approaches to the future when it comes to a company. They have actual cash. That's why they can pay a dividend.
Actual cash. I think that's funny because earlier we were talking about companies that are trading 100x earnings and they have zero earnings or negative earnings. Yeah. It's all the future, the thought, the hope. And sometimes when the market gets ahead of itself and there's a lot of quote unquote easy money flowing around, that's what happens.
Yeah. Some of our advice. Yes, we have clients that are do-it-yourselfers, clients that invest on their own. And sometimes we use this concept called take your winnings off the table. And those are at the best of times. We say take your winnings off the table. When things are not the best of times, things are down and markets have pulled back, do we sell at that time? The answer is sometimes we have to. And the reason is sometimes people have all of their money at risk and in the wrong place, and they might have to make some changes. We might not make it quickly. We might try to balance it out. We might do some things such as have your dividends go to cash instead of buying more of the same stock if you're overconcentrated. There's a lot of little tricks when it comes to financial planning and getting proper advice.
Yeah, so my favorite thing right now, Brian, is Roth conversions. Now, let's say that you own good stocks.
Yeah.
You know, the things that you think are going to do well over the next 5 to 10 years. And let's say your income's down a little bit because it might be in this year.
Sure.
Who knows? In a time like this, it could always fluctuate. But let's use that as an opportunity, pay the tax on that stuff now and use that year, this time, you know, of hardship, recession, whatever you want to call it, as an opportunity. And it's a big win.
If you think about retiring, and one of the concerns about retiring is can you keep up with the cost of living? Cost of living and high inflationary times means your money has to make money to keep up what you're spending already. One way of doing that is having stocks that have good dividends, money that's going to be around and grow and beat inflation over time. Very important to have. The second thing is let's lower our budget. One of the bigger components of our budget is our taxes. By doing what Alex just recommended, a Roth conversion within your current bracket, especially if you're in your 60s, is one of the best things you can do in your long-term plan and your long-term retirement plan is to do Roth conversion, something we highly recommend in a down market to convert the high-quality investments and watch it rise back up tax-free.
And one of the most fun things about that, Brian, especially if someone has a bunch of cash, like they're in the bank or something, and they're like, what do I do with my cash? It's, you know, constantly depreciating, but I don't want to jump in the market, you know, yada, yada, yada. And I say, okay, well, let's convert money we already have in the market, use the cash to pay the taxes. And essentially, you're prepaying your future debt. It takes care of your inflation worries because you're paying in today's dollars, not future dollars. I mean, it's an all across the board win. And a lot of people out there listening, they're like, well, I only have my thing at work. Well, guess what? A lot of those plans will let you do it right there in plan conversions now.
Yeah, it's hard to do, and we do a lot of them with the private IRAs, individual IRAs, because we can handle how much, what, we can identify certain pieces, which is a really good thing, especially if somebody's been investing in different types of stocks with their IRA investments, is understanding what to convert now. Converting actual stocks is a good thing.
Yeah.
Now, when it comes to other ideas with opportunities, when high quality, let's call it technology stocks are down, if they have good P/E ratios, good quality earnings, and they're way down, there might be an opportunity to buy. Understanding in the long run might take a few years to get back to where they were, but it might be one of those investments that could give you a 1x, 2x over time here.
Those are fun ones too, but you know, the main thing is looking from the top down. Because I've had clients where they're like, well, why would you recommend I buy this right now? It's not down as far as, you know, X, Y, and Z. I'm like, well, if I look at your overall portfolio, you're still 20% overweight growth,
right?
Just by the nature of people chasing returns. So we need to add to some of that value, that quality. And the quality, it's stood up, and it's, you know, like you said, it'll pay you to own it. Thank you.
Yeah, the other thing is you have cash. You're sitting on cash and you want to invest it, and you see, a 5-year CD rate at 2.5%, and you get all excited about it. Understand that we're in a rising interest rate environment. You don't want to go 5 years or longer right away. You want to maybe ladder that out. Laddering is to have different time spans on your money, like having a 3-year and maybe a 5-year. There's CDs through banks. There's fixed annuities through insurance companies. And you can have the ability to lock some of your money up at a lot better rates than we've had been earning in banks.
Yeah, and I agree with that 100%. Not wanting to go out 5 years. I typically tell people, well, look for that 18-month teaser rate where they're trying to get you in. And it's usually as much as their 3-year rate sometimes. Well, let's do that. And then in 6 months, let's see where it's at.
Yeah. So what today's show has been about is retiring in a recession, about having this positive attitude about what's going on when it comes to your retirement plan, that you've done the work, that you've put in everything you need to do. Now, when you listen to the show, you might think, oh, I haven't done that. I haven't thought about that. Well, that's exactly when you need to give us a call to have that second opinion about what you can do now to improve on things. Have you been seeing people like that?
I have, probably 4 or 5 new people each week here this past month with just like, hey, Alex, what should I do? And sometimes it's like, you did a great job.
Absolutely.
And sometimes it's like, I need to see you tomorrow.
Yeah. Yeah, it's sort of like a broken arm versus a splinter type thing, or slow heal. But the idea is this, is that winning in retirement takes planning, and you need to do that, and you need to do it well for you and your family. Because what we want you to do is to win in your retirement years. You can begin winning in retirement by giving us a call for a free meeting with one of our team of advisors. You can go to our website, the akersfinancialgroup.com, scroll down to the schedule a meeting section, and let us know you'd like to schedule a free meeting. That's akersfinancialgroup.com, where you can go ahead and give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or give us a call at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.